I do feel like this is a trend that we've seen for a few years now, that buyers are pulling back. And it is, in my mind, truly unfortunate because we were just gaining momentum. We were beginning to scale the markets. And just as a quick side note, Anu saw that demand and we went big. We raised and deployed $1.8 billion to go out and buy 1.7 million acres in the US of forest land that was being managed by industrial timberland owners. And now we're managing that land for a carbon first approach. Carbon storage and carbon removals is the number one driving factor on those lands for revenue, rather than timber being the driving factor. And so we went big. We are now the seventh largest forest landowner in the US. That's huge. We're up against the limes, the Weyerhaeusers, the big ones. And we're really trying to throw that industrial timberland model on its head. And in order to do that successfully and also go out and buy and acquire more lands, we need that strong demand signal.
Welcome back to This Week in Carbon. I'm your host, Eddie Smith, alongside Rene Velasquez. And today we have an amazing guest, Lizzie Aldrich from A New Climate. Thank you so much for joining us today, Lizzie. Really appreciate you being here.
Thanks for having me.
Yeah, of course. Well, we've got some great stories and topics to dive into from this week. But first, we'd love to introduce you to the audience and personally learn more about your background in the space and your role at Anu, and a little bit more about Anu's work in the industry as a longtime developer, I believe. So yeah, would love to kick things off that way.
Great. Well, thank you. Yes, Anu has a really long history in the carbon offset and removal development space, given that there are a lot of companies that are new entrants. Our background goes all the way back to 2001. And at that time, we were Blue Source, and we're a merger of another company, Element Markets, that was founded in 2005. And we merged in 22 and became Anu. And at the same time, we were acquired by private equity, by TPG Rise Climate Fund. So really exciting and great to have all that brain power together. And we have also grown the team since then. In fact, we have a new 50-person office in Munich working in biomethane markets. So just to kind of back up, our history is in carbon offset project development. And that's both in compliance markets and voluntary markets. It started out in voluntary markets since those were the only markets in 2001. And over time, we got active in the California compliance market, Alberta tier market, and grew our position in voluntary markets as well. We had a lot of success with that. So we delved into biofuel markets in 2011 and began developing projects under the Federal Renewable Fuel Standard 2 and the California LCFS program eventually. And so we also work in those biofuel markets, and as I mentioned, expanding into European biofuel markets. And we also work in ELCFS markets in California and British Columbia. So we're really diversified across environmental products in North America specifically, and now delving into Europe. And our project development work, I should say, is really focused on the US and Canada. And I think that really differentiates us from some other developers out there that went worldwide pretty quickly. We have, I think, done a really good job of establishing ourselves in the US and Canada and made a really intentional choice not to get spread across too many time zones too quickly, and also operate in countries where there's a really well-established rule of law and boundaries are respected, and we were able to mitigate a lot of risk by doing that. And so that's a little bit about who Anu is. And I personally have been in these markets since 2004. I started out with my PhD in early carbon markets from the University of Colorado. And I studied CDM markets in Latin America, ultimately turned that into an investment guide, a book that was published in 2009. And then I worked for an early offset developer starting in 2008 in the US when we thought Waxman-Markey was going to pass. And developed some livestock projects for offsets. And then it was fun, full circle, got to work on some of those same livestock projects, converting them to LCFS crediting in 2018 when I joined up with Blue Source, which became Anu. And so I've been in it a while. I've been on the teaching side, teaching at Boise State University in the MPA program, and also my own consulting company. Got to work with folks like Cristiana Figueres and just really doing some fun work in the space through the years. So it's been an interesting ride to see where our markets have gone.
Yeah, certainly. Well, thank you for the background, Rene. I see you kind of smirking over there. It's like, what was that? The case you mentioned? I never heard of that. Did you mention a lawsuit that was going to be passed or something?
No, Waxman-Markey, the Waxman-Markey bill. Yeah, it was
the Waxman-Markey bill.
It was passed by the House of Representatives, but it was not passed by the Senate. And so this was 2009, and we all really thought it was going to pass both the House and the Senate. And that's why there was a big buildup of kind of carbon offset project developers at that time. And CAR, the Climate Action Reserve, was really created to develop the protocols for the California program, which they then thought were going to get utilized at the federal level. And there was a lot of hype and buildup in the US because we all thought we were going to have federal cap and trade in 2009. And that was actually the reason why the project developer I worked for at the time, Camco, developed their office in Denver, Colorado. They were a UK-based company.
Yeah. Awesome. Well, yeah, I could definitely see
what could have been. What could have been. I remember that time as well. Yeah, I remember. Yeah. I was at First Climate at the time, and they had invested a lot, like you said, a lot of other developers in the US in order to build out a workforce and be able to help to meet the expected demand. And then when that fell over, obviously those investments were no longer essentially viable, and a lot of folks retreated from the market, and it was this huge letdown. But you've been steadfast. Like you said, you entered this space in 2004. That's incredible because, to put into context, right? The Kyoto Protocol, 1997, right? Ratified. And then in the EU, the first phase of EU ETS is coming in 2005 and then 7, right? In terms of actual implementation. So you came in right at the beginning. So how did you actually find your way into the economics of climate and carbon as a subject matter? I find that journey fascinating. That's a great
question. Well, I originally was, during my graduate studies at the University of Colorado, really interested in renewable energy markets. And that's where I thought I was going. And through doing various fellowships at NREL, the National Renewable Energy Lab, and I worked at the Rocky Mountain Institute, RMI, and I had the opportunity to be an Argosy fellow there. I worked at eSource for a bit. These were great stints throughout grad school. So I got really interested in renewable energy markets, and this was kind of at the beginning of the VPPA time frame. And I was tracking compliance rec markets, voluntary rec markets. And I also was thinking about contract for differences for some RMI clients that were really throughout the US, and what they could do through creative structures to save money by actually investing in renewable energy. So this was really at the beginning stages of that trend. Knew Quail and some of the folks who started Renewable Choice Energy and some of those kind of leaders in the space. And then I ended up kind of becoming more and more interested throughout grad school in these emerging carbon markets, and they were very new. And I wanted to look at what barriers project developers had to achieving carbon revenues. I was really curious as to, okay, how is this going? The UNFCCC just set up this registry. There are all these methodologies that are being developed. And I wanted to see specifically with renewable energy how it was going. And so that's what I focused my study on that became a book, was what are the barriers to renewable energy project development. And initially I wanted to look at small scale renewable energy under 15 megawatt capacity, but it turned out there weren't enough at that time to really make a robust study. So I had to expand it to all renewable energy projects. And I traveled throughout Latin America for 6 months, interviewing project developers from AgCert, MGM International, EcoSecurities, going to project sites, sometimes small hydro in Honduras with like armed guards had to come with me because hydro had quite a bad reputation in Central America for displacing folks in the 80s. So, but just getting out to project sites, a lot of manure lagoons throughout Mexico, and learning what were the barriers to these projects actually earning CDM revenues. And as it turns out, a lot of them were technical barriers that were really simple. I mean, things like water pooling on the top of lagoons in Veracruz during hurricane season, where then they didn't have a pump to get the water off, and they had no way to get in touch with the capital to get an engineer to get someone out. You know, simple things like an ignition line for the flare, too close to the flare and burning, and then all the biogas is just going into the atmosphere and not getting flared. So there were the technical pieces, but then there were really interesting institutional barriers, because the UNFCCC process was so complicated. And if you didn't speak English, it was super hard to navigate. And then also just learning about the different electrical grids in each country. Like in Mexico, it's primarily a monopoly. And it was very hard for independent power producers to jump in and get CDM revenues, because there was actually a limitation on how much capacity they could bring in. It was limited to 20%. Whereas Guatemala, just south of them, totally privatized electrical industry, and it was much easier, and therefore Guatemala had a lot more renewable energy CDM projects. And so I learned a ton. It was fantastic, and then really set the course for my career from there. I just, I was really well positioned to work for carbon offset project developer, having done all that work and research and interviews and project site visits. And so that really kind of set the course. And hopefully today we can talk a bit about Article 6, because it's fun to see this come back around in 6.4.
I was going to say.
Because I got to visit the DNA offices, the designated national authority in a lot of these countries, and see on the ground, like literally how this was set up and how developed it was in some, and how it was very rudimentary in others. And I think we're going through that same process now through Article 6 with the setup of these national registries and the DNA again, and having to wait on these countries to actually get the structure ready so that we could actually have ITMOs trade. And it's gonna be a slow one, I think, especially now given that they have their own indices to meet, and it's quite a bit more complicated. So yeah,
we've only just added extra complexity to the system. But yeah, I completely agree. I think that you highlight institutional and operational inefficiencies, and those will persist, right? That's just the nature of projects. But fascinating background. Thank you for that. And I mean, I just hold you and the team at Anew, whether that's Kevin Townsend or Andy or Thomas or Kelsey, and like you guys got such a great team of such dedicated professionals that have, like you said, you've been historically very focused on North America, and it's kind of like when you have a question around Canada or US, it's just like, right, pick up the phone and send you guys an email. I know you're close friends with Scott Hernandez, who's a mutual friend of ours, and we always reach out to you guys for that. So it's a pleasure to be on this one, and looking forward to the conversation. Eddie, back to you, mate.
Yeah, so maybe I'll bring in the corresponding adjustment in Article 6 story to be the second one instead of the third, so we can make sure to touch on that. But yeah, to start off, wanted to start by touching on this state of the voluntary carbon market report by Ecosystem Marketplace. As we know, it was just released this past week, and The report paints a picture of, a market in flux, right? With sharp declines in transaction volume, you have softening average prices and shifting demand dynamics. But rather than a market collapse, the data suggests that the voluntary market is undergoing a strategic reset, right? Particularly on the supply side. So in 2024, here's some quick facts and figures. The reported market transaction volume declined 25%, and average prices dipped by 5.5%, with total value falling to $535 million, a 29% drop year over year. Yet retirements remain stable at elevated levels, with 182 million tons retired from the top 10 standards in the market, signaling that, end use demand hasn't disappeared, but it's been resilient. And notably, carbon removal credits are commanding massive price premiums, averaging 381% higher than reduction credits. And while removals still only represent just 5% of the markets, obviously interest and value are growing rapidly, especially around reforestation and agroforestry projects and blue carbon project types, while categories such as, Red Plus continue to lose market share. And improved forest management are seeing an ARR, which I mentioned, are seeing sharp growth in both volume and pricing. And the report also highlights the rising role of integrity frameworks, particularly the ICVCM's core carbon principles, which is influence demand and for approved methodologies like landfill gas. And taken all together, I think like the data suggests market shedding speculative excess, like you said before, Lizzie, like a lot of intermediaries kind of stepping out of the market, a lot of speculators stepping out of the markets, and with tightening supply, and there's a lot of sitting and waiting for clarity from integrity bodies, from the corporates. So with all of that being said, from your guys' vantage points, would you say that's an accurate read, or is there something deeper going on? Like, I'm interested to hear your thoughts, and how should we interpret this drop in transaction volume? Is it signaling a pullback in confidence, or simply a pause? Yeah, would love to hear your thoughts.
Well,
Liz, you want to go first?
I'm happy to go first, and Rene, I look forward to hearing what you think too. This was great that new report dropped today, so we could talk about it. I do feel like this is a trend that we've seen for a few years now, that buyers are pulling back, and it is, in my mind, truly unfortunate, because we were just gaining momentum. We were beginning to scale the markets, and just as a quick side note, Anu saw that demand, and we went big. We raised and deployed $1.8 billion to go out and buy 1.7 million acres in the US of forest land that was being managed by industrial timberland owners. And now we're managing that land for a carbon first approach. Carbon storage and carbon removals is the number one driving factor on those lands for revenue, rather than timber being the driving factor. And so we went big. We are now the 7th largest forest landowner in the US. That's huge. We're up against the Limes, the Weyerhaeusers, the big ones. And we're really trying to throw that industrial timberland model on its head. And in order to do that successfully and also go out and buy and acquire more lands, we need that strong demand signal. And I will say, through that venture with Aurora Sustainable Lands, it's a joint venture between Anu and Aurora Sustainable Lands, it's been really successful. Buyers love it. It's a great, compelling story. And I really have confidence that we're going to be able to actually go out and acquire more land in the future. It has been really incredibly popular among buyers. So that is very exciting. But we also need more buyers in the marketplace. And what I've seen from my perspective, working with buyers every day, I had our voluntary sales team, is that I see that there are buyers that are going big. And last year we had a couple of big transactions with Microsoft for nearly 1 million spot removals, Total Energies, and those types of buyers are buying with conviction. JP Morgan, and they have their own rubric and framework for what they're buying and why. And they have big enough teams, by the way. Microsoft is like a 20 plus removals team only to vet projects. And they also hire outside consultants to help. And they do a great job and really do a tremendous amount of due diligence and make their choices. A lot of small and medium-sized businesses don't have that luxury. They don't have 20-person teams. They have one sustainability person, and that person's in charge of plastics reductions, water reductions, carbon, et cetera. And so it's really hard to decide what makes a high quality project and stand behind it. And I'll also say, you know, a lot of those buyers, like for example, Microsoft, and there's some other big ones like Unilever and Amazon, who were actually kicked out of SBTI. They timed out of it. And it's really interesting. They continue. They're not stopping their climate actions. They're not stopping what they're doing. They forge forward, and they feel really good about their own framework and what they're doing and their goals and how they're achieving those goals. So I really give them props, because I know not every company can do that. And we're also sitting here in the wake of lawsuits for Apple and for Avion and others who have made carbon neutrality claims. And obviously that's going to scare buyers from the market. So what we really need is safe harbor. We need buyers to feel good about what they buy and allow them some safe harbor for if they've purchased a product that, say, for example, has a CCP label, which is an initiative under ICVCM to provide an additional label on certain offset projects and removal projects that are deemed high quality, then they're free from criticism. They're doing their best. At least they're doing something. And it's always ironic to me that it is the companies that are doing something that are getting criticized, rather than the thousands of others that are doing absolutely nothing as it relates to climate. And so I think that we really need to provide safe harbor for the buyers and have guidelines that they can use that will actually help them achieve their corporate targets. A lot of the SBTI companies, I wouldn't be surprised if you see some of them dropping out in the future years, as they realize how hard it is to achieve those standards, especially for the heavy industry, because the targets are so stringent. And I think it's great that they're stringent. We got to meet those climate goals, but at the same time, they have to be attainable, and they have to have a trajectory for those companies to get there. And to date, it's been extremely hard. And we're in the midst of a version 2 draft from the Science Based Targets Initiative, where they've put together this net zero standard, and it's in version 2, and it's in a public comment period until June 1st. They're going to receive all those comments and go through the process of trying to revise it and hopefully make it workable and attainable. The new CEO of SBTI says that he is really trying to make it more attainable for industry to actually comply with. So that is what I see, Eddie. I'm sorry, it's kind of a long-winded answer, but I would say, yes, there's some stagnation. There's buyers who are going big and standing with conviction around what they're buying and why. And those tend to be, from my perspective, large companies that can have their own framework and feel really good about their own framework for what they're doing and why. And then there's some other buyers who maybe bought a little bit or were on the sidelines thinking about buying, and they've kind of retreated. And to me, that's a real shame. And we need to provide, we as an industry, need to provide them some safe harbor for buying and some guidelines. If it's not SBTI in this new iteration, which may have some room for the use of instruments, tradable instruments, but if it's not SBTI, it's got to be some framework where they can go to, the sustainability officer can go to their manager and say, hey, we're going to purchase this amount, and it correlates to our inventory of emissions. And we need this much money, and next year we're going to need Y amount of money and Z amount, so that they have some trajectory and certainty and can move forward with confidence. And if SBTI aren't the guidelines that they can use to do that, then we absolutely need some, because in the absence of that, these companies aren't doing anything. They're not. And so if our markets aren't perfect, then let's really try to improve the quality, and we can talk about quality improvements next. But let's try to improve the quality, and let's also give those buyers some way by which they can participate with confidence in these markets.
Yeah, I think you hit the nail on the head there. Yeah, Rene, did you want to jump in here?
No, I'm just completely in agreement. I love this notion of safe harbor. That's exactly what the market really needs, and you highlighted the reasons for that. I think that gives that tacit endorsement for participation, whereas right now we have this perversity around penalizing the action. It's this voluntary sort of paradox that Steve's work and Rene kind of highlighted. That if you're acting voluntarily, you're not doing it well enough, right? And so then these lawsuits and stuff sort of start to emerge. I hope that that these lawsuits do keep coming, and that then the jurisprudence is actually settled, and so that there's a precedent for supporting the action. And then, like you said, further inclusion around the participation around the various different metrics like SBTI. But if I can just bring it back to the ecosystem marketplace report. And look, this report has been going on for a very long time, and it's an awesome one. And now I think it's like either the third administration that's been writing these reports. So I know it's Alex Procton who wrote this one with the help of obviously a lot of other very smart people internally. Previously, it was Stephen D'Onofrio and Kelly Hamrick, who I hold in great and super high esteem. To answer your question, Eddie, I think that that the direction of travel of the report is correct. Essentially, they highlight that there's a lack of liquidity. So completely in agreement there. What I will say, and it's not an indictment in any way, shape, or form of the report itself, but it's to do with the way that the data is collected, which is the best possible way today, right? Which is it's a survey. And so it requires a voluntary participation disclosure of data, oftentimes with commercially sensitive data. And so not all participants in the market actually report. When you look at the bottom of the report itself, it has actually a really wide number of participants, and a lot of the big shops are in there, and that's great. But there are clearly gaps. What we see here, and this is why there's this story around, or this direction of travel being around the lack of liquidity. You see mostly the project developers and then the secondary market intermediaries, right? Whether they're brokers or trading houses or intermediaries. And actually, we don't see many of the big trading houses. Like I don't see Vitol in there. I don't see Traffic Bureau, and I don't see Shell in there, right? Shell, big corporate buyer, and so that's 15 million tons that's not reported in here unless it was captured with some of the project developers that then sold to them. And so there's this opacity that's pervasive, and it's not an indictment on ecosystem marketplace. It's just unfortunately the way of the way how it works. When I was at Expansive, obviously we worked really closely with these guys, and I wish that there was a way to export the data that sits on the exchange in a much more transparent manner. I think Expansive's done a good job of improving that, but there's a lot of data that sits behind the market, let's say on the registry, that is not yet accessible. So it only tells part of the picture. So that's that bit. So I wouldn't put too much stock into the actual numbers, like market cap. Let's dismiss that because there's some pretty big error bars, right? But that's what I'd say there. But
I
the thing that I
completely agree, and I'm also surprised at how many actually do participate and contribute. I think it's been this really nice kind of cadence and industry participation voluntarily that folks have done. And as the industry grows, I wouldn't be surprised if we have fewer and fewer folks reporting, because there'll be new developers that are like, well, why would I contribute to that? I think it's really valuable to have, but I do agree that because it's just this voluntary reporting basis, there are likely some big gaps.
Yeah. I mean, I think I could name 10 offtakes that are like the combined future value of those offtakes are larger than the reports. Like
exactly. Well, Lizzie, you mentioned it, right? Transactions that you did with Microsoft and with JP Morgan, and so I noticed that obviously Google, and so basically the story is secondary market representation is fairly good. I don't know what would give it as a score, but like 70 to 80% of coverage, which is excellent. But the primary market transactions necessarily haven't been that represented because of disclosure issues, and so ecosystem marketplace are doing an amazing job and continue to do an amazing job with the kind of limitations that they operate in. But overall, it's good because there is certain data that is actually robust and really verifiable, which is the issuance and then the retirement numbers. And those numbers actually speak of a very stable market. Certainly isn't growing, and it really supports what we hear, let's say, in terms of on the street, or what we see, across the trading desk, which is primary market transactions are robust. There's this decoupling in the market between, let's say, the constraint of supply in CDR, so carbon dioxide removals, whether that's nature-based removals, think blue carbon, think afforestation, reforestation. That still remains very constrained in terms of spot supply, and everything is sold now on the forward curve. And then you look at biochar, so now going into durable CDR, whether that's biochar, enhanced rock weathering, direct air capture, these become more and more scarce. And as a result, and you see it in the report itself, you see the average price. I point to figure 7, and I'll get our producer Olaf to put that figure in, and it's got the distribution in terms of value on the y-axis, and then the kind of distribution of how much of the cumulative market is traded across each one of those buckets. And you see the durable CDR and even nature-based CDR at the right end of the spectrum, much higher average prices, and so they are just tip of the iceberg so far. But show the direction of travel again in terms of where the market is going. I think this kind of question around integrity, quality, etc. There's a push towards more durable solutions, more towards removals, and a move away certainly from let's say more established historical methodologies. To be fair, like renewables have done such an amazing job, but they are being phased out of the market due to additionality concerns. And next year is pretty much the last year that the historical projects will continue to issue at the end of that crediting period. So that's kind of out. And then you've got essentially cook stoves that are issued quite a large volume, but haven't necessarily found that market fit because of integrity concerns and the FNRB. And then you've got Red Plus, which is such a large portion of supply, but that's played with questions around overcrediting and certainly structural questions around jurisdictional versus project-based. So you've got these, I don't want to call them stranded assets, but less favored methodologies, certainly. And they obviously, the tape tells it all. The prices for those are lower because the bid action is a lot less, and you got a lot more offers, and so you get this supply-demand kind of imbalance, and prices tend to drive down. Whereas it's the inverse on the durable removal. So anyway, tale of two cities, effectively, durable and nature-based CDR on one side of the market, huge potential demand, very limited supply today, and a latency in which that could actually ramp up. So as we achieve scale, it's going to take some time for that to emerge, and it's just this awkward transition that we find ourselves in. But I take solace and final comment in the fact that the market is resilient. There's I think it was 182 million tons of credits retired in 2024. That's excellent. And when you look at the historical context for that, like there were much leaner years historically, and the report highlights that. So I think overall good news. It could be much better, and I'd love to see the secondary market to start to gain more of that liquidity. But that only happens when more and more buyers start to come in, and they're unable to access the primary supply, and they have no other choice but to access the secondary market. So I think this too shall pass, and the market's going to be okay.
I would just add that I think, in renewables, it's fun to look back at my book and see all the dust it collects, because you're right, like carbon did its job there. And in addition to, in some places, RECs and GOs where you have additional support through market mechanisms for that particular technology type. And now we don't need carbon revenues to help support large scale renewables. And so that would be fantastic if we could phase all these project types out, if we could give them a jump start with carbon, and ultimately there was, it survived on its own, and, renewables being at grid parity, that's just like the perfect example. I would I would say with the removals trend, you're absolutely right. That's what people want. There's not enough available supply. I think nature-based removals are a great transition to some of those more durable removals that have, say, 1,000-year permanence or proclaimed 1,000-year permanence at this point. And there could be a really nice intersection of the two where, nature-based is filling the near term and the more durable is filling the long term. But I just think we can't throw away this notion of avoided emissions or reductions because those are still so key. And I think in the frameworks and the guidelines that ultimately emerge in our market, there should be a transition. Yes, ultimately, we know by 2050, we're going to have to rely on removals. But the bottom line is we're not living in an era where every single country has caps and every single industry is capped. And if we were, then reductions and avoided emissions really shouldn't play a role. But we're not. Obviously, here in the US, we have limited RGGI in the Northeast. We've got California. We have some emerging state-led initiatives for greenhouse gas markets. But we have so many opportunities that are low-hanging fruit that we can still take advantage of. And I hear every day new developers coming and saying, I have this really cool idea, but it's creating a reduction. And I kind of go, I wonder if it's going to fetch a high enough price to actually incentivize that project to move forward. But by focusing only on removals, we're really making it harder for ourselves because it's so much more expensive to pull the CO2 out of the air once it's already in there. But if there are opportunities now that are truly additional that can avoid the emissions going in the atmosphere in the first place, we should do those. And if it means we have to build that into the guidelines as far as a transition to get there, then so be it. There's certainly precedent for that in California in the cap and trade program. There's a certain percentage that those regulated entities can use offsets for. And in fact, of that percentage, there's actually half of it has to come from the state of California now to have direct environmental benefit to the state of California. There are ways to set this up such that you can set caps and sunset clauses, but we really, I think, are shooting ourselves in the foot right now by not allowing avoided emissions to count in the same way and having the IPCC putting that out there and then SBTI picking it up and saying, we got to really myopically focus on removals has caused so many corporates to just really focus in on that. And we're missing out on a lot of climate action that I think could move forward.
Yeah, we're in wild agreement. Yeah, we need both, and we need them at scale, and that's the take home message that I get here, that the market saw the beginnings of a speed and scale kind of movement where we had such great participation, and then the trust was eroded, and then we've had essentially a retreat in terms of participation. There's an underlying market that will still sustain a lot of the kind of the folks in the space to continue to do the great work that they're doing, but we need much broader participation, again coming to the safe harbor kind of concept, and and then greater investment in the underlying project types. And if there is a preference or a bias towards the nature-based removals or the more durable removals, then great, that needs to emerge. I don't think it's happening at the scale that people wish that it could, even with this whole dependence, like you said, with regards to removals in the 2050s. It's not like it happens immediately. You wave a wand. These projects have to stand on their own 2 feet. You referenced, renewable markets at the beginning. The project financing for those was tenuous at the beginning, and then they became much more established, and you had access to capital markets because you had hard assets and you had a strong demand through VPPAs and these types of innovations that securitize essentially those transactions. We're at the beginning of that in carbon, and kind of beginning because we keep going around in circles, but we kind of keep coming back to this point. And Eddie and I have talked about this ad nauseum with clients, and I think even on this podcast, but a lot of the projects don't get financed until they have been de-risked on the offtake side, and that requirement is really inefficient allocation of capital. And what we need again is an emergence of market signals, particular on the futures side, right, through CME and ICE, in particular as exchanges, ABACs and others, where we have a future settled price signal that the financiers can now use as a hedging tool in order to underwrite the capital allocation so that it's not 100% predicated on offtake. And then capital will start to flow, and you'll start to see these green shoots emerge around project implementation. There's still a little bit of a lag of supply, like you said, on the avoidance side, but the market, the tape tells it all, right? They're being discounted. There's still opportunities there, but let's put it into the context. Like, we're talking about hundreds of millions of tons of supply in this market where we have billions, tens of billions, 40, 50 billion tons of emissions. This market wouldn't be necessary if we didn't have these emissions. And essentially we're clutching at straws and having these kind of debates around greenwashing, et cetera, whilst Rome is burning effectively and almost literally. So,
agree.
Let's just get on with it.
The long-term offtake piece is really critical. But, speaking from the project developer side, that really helps those landowners we work with, project owners, to have confidence and certainty. And it is a little bit like the PPA model, but the difference is, I think, is really critical, because every buyer comes and says, I want to basically help a new project, and I want to be involved, just like the early days of the 2000s in this collective VPPA model where all these tech companies got together and supported this wind farm, et cetera. Well, the difference is right now they're not obligated to buy carbon. They were obligated to buy energy, and they could do something creative like a contract for differences. And they could have ended up actually saving money in addition to getting renewable energy. And so the difference now is we really need that kind of mandate, whether it's compliance or pressure, so that they join a voluntary collective and they have the guidelines that do allow for carbon credits to qualify. And then they have that pressure to procure the instrument and get the long-term offtake at a price that they can rely on, budget for, and in fact, they might come out ahead, just like those that got into the early days of the VPPA. Those that get involved in a long-term offtake from a removals or an avoidance project really might come out ahead, because they might end up actually saving money because of a very modest inflation now on a long-term offtake, whereas we know there's going to be a lack of supply in the future and the prices could go wild. And so I think that truly it all comes back to the standards and the guidelines and making sure that those are inclusive of these instruments. And if they are, that becomes the driver, just like these companies that they needed electricity and they wanted to save money and they want to do the right thing for the environment. Well, the VPPA model really checked all those boxes. In order to have that in carbon, they've got to have the driver too. And so it's not just a voluntary action. So sorry, it all comes back.
No, that's the Achilles heel of our market. That's the Achilles heel of the market. And that demand signal not being strong enough, that's what undermines the potential for growth here. And look, it is what it is. I think that starts to change, certainly under the Paris Agreement. And we're seeing now a distribution of that regulatory capture making its way through Article 6.2, and then these national systems that are allowing for the fungibility of project-based approaches, in particular with ITMOs. And so now you have this fungibility of this instrument type that is now a cross-border transactional instrument, and how that's treated from a legal, regulatory, and kind of financial markets piece is going to be really important, and that will drive that innovation. And it borrows a lot from what have been traditionally the voluntary markets. So really interesting. But there is a rate limiting step, which is corresponding adjustments. And Eddie, I think that's your transition.
Mm-hmm.
Yeah,
and I do just want to put a quick plug in, just because, New has a really unique ability to do long-term offtake to provide the price stability into the future, and that we are the landowner. We, with our JV with Aurora Sustainable Lands, for a portion of our portfolio, we're the landowner. And in other cases, we can do up to a 10-year offtake. So we can do 10-year plus offtakes with really modest escalators on prices. And that's something you won't find. In fact, we can actually even do a firm forward if somebody's willing to accept, for example, a project that is from a particular methodology, not a particular project individually. That's too much risk. But if they're willing to, say, for example, accept removals from IFM in North America or in the United States, we can guarantee that. And we can do a firm forward for 10 years out. You won't find a lot of project developers that can do that. We're very big.
Because they lack the balance sheet.
So it's, and so hey, we're ready to do this PPA type model, and we can fix your price so you can budget on it. And so I think that's pretty unique, and I'm hoping that's going to help drive some demand too going forward, because that's pretty recent thing that we're big enough to be able to do that.
Yeah,
Yep.
yeah, certainly. That's a strategic, asset.
Love the plug.
Right? And I love everything that you guys were saying, and I think we could talk about, all those different topics for, probably 7 hours. But I think it's time to move on to our next topic, which Rene, you mentioned about corresponding adjustments and Article 6. And this is with regard to a recent story that I read on Carbon Pulse around the lack of clarity on corresponding adjustments, which is keeping investors in the dark. And it seems to be a very pressing challenge in both voluntary and compliance markets today, around that lack of clarity over corresponding adjustments under Article 6 of the Paris Agreement. So we're seeing project developers becoming increasingly uncertain whether their credits will be eligible for international trading or meet market and compliance expectations. And due to opaque and shifting guidance from host countries on how or if they'll authorize adjustments aligned with their nationally determined contributions, their NDCs, I saw a quote from some experts speaking at the West Africa Carbon Markets Hub, and they were saying how NDCs are often treated as moving targets by governments, and it's making it unclear whether a given project will ultimately be authorized for use under schemes like Corsia or other compliance markets. So a lot of these developers feel that they're being left in limbo, right? Like unable to price this risk appropriately or guarantee credit eligibility. So this dynamic is kind of stalling investments and delaying project pipelines. And, it puts at stake whether countries will build domestic mechanisms or continuing to leverage third-party standards on, and how this evolution could reshape the global supply of high integrity carbon projects. So I would love to hear your thoughts on this and how, from a project developer's perspective, how developers are managing Article 6 risk, and particularly around corresponding adjustments and host country approvals. And, are we seeing any clear signals from host governments about their approach to authorizing projects for Article 6 use? And what does that communication mean, from the investment side? I think it's a really interesting topic and debate to be had in today's market. And this is something that Rene, you and I discuss consistently throughout the past few weeks. So I'd love to get your guys' take.
Yeah.
Lizzie, you want me to jump in on this one first, or you want to go first?
You go ahead, Rene. I want to hear.
No, I just think it's a and I'm sending meeting notes to Olaf, our producer, so he can attach or add the graphics that I'm going to reference previously to the State of the Voluntary Carbon Market Report. But basically what I said before, which is corresponding adjustments are the rate limiting ingredient or step in order to help to scale this international trading under the Paris Agreement. So effectively, you've got, and there's a great schematic that Bjorn Funden from AIDA prepared for a report recently commenting on Indonesia's carbon market, and I'll put that in the show notes and share it. But essentially, he defines three main approaches in order to deliver credits, and then what type of credits kind of follow through. I'll try to simplify it verbally, but effectively, you've got these independent crediting mechanisms. Think Vera, Gold Standard, CAR, Circarbon, Eco-Rich, Pure Earth, etc. Right? And then you've got the next bucket, which is a centralized approach under the UNFCCC, so the PACM, the Paris Agreement credit mechanism under Article 6.4. And then you've got government crediting systems, so domestic systems, think about China CERs and others. And essentially then, in order for countries and compliance systems like Corsia to receive these units, you need what's known as this corresponding adjustment. It's essentially an accounting mechanism to allow the host country to export that unit and not double count it in their ledger to another country on the buy side. So then you take away that reduction and then you add that reduction on the other side. So it's like a negative integer and you add that negative one. Cool. That's what that's for. And Corsia's, a interesting market because it requires that as the caveat. You also have it from the independent crediting mechanisms, the ability for having that corresponding adjustment, I should say, to define what's known as the ITMO, and under 6.4, it's the Article 6.4 ERs. You also have the ability just to not have the corresponding adjustment. And that then leads to either a contribution claim at helping the country to meet its own nationally determined contribution, or a purely voluntary market kind of claim. And I think that those last two are kind of interlinked. I had an interesting conversation about this with Rich Gilmore, but I digress. And anyway, the allocation of these corresponding adjustments, that's the tricky bit, because it comes at a cost to the host countries. So essentially, every time that they export that letter of authorization and then they make that corresponding adjustment in their ledger, they're making it harder for themselves, the country, the host country, to meet their commitment under this NDC. So because it comes at a cost, as opposed to like what you mentioned earlier, Lizzie, which is the old CDM, where it was just this opportunity for finance to come in and then essentially Annex 1, Annex 2 countries, and Annex 2 in particular, to just generate a whole bunch of revenue and sell these credits. It didn't come out as a penalty. So this is one of these features in the Paris Agreement, which is really critical. And as a result, countries are starting to recognize that there's an inherent value for them to make that export of those CAs. And it's become increasingly difficult for project developers to access it. And I also think that it's an inefficient approach to have a negotiation between a government and a project developer, because you have this unfair asymmetry. It's David versus Goliath. And it's no surprise that we have seen very few transactions to date. Governments are still trying to reckon and reconcile this notion of, you talked about the NDAs, right? Like what the national registry system's capability is, right? How they're tracking it. Which department is actually in charge of signing this? Is it Finance Ministry? Is it Environment Ministry? Is it Treasury? And so these things, the architecture is still being defined. And so it's no surprise that it is difficult. And we're hearing gripes from project developers saying that that's the case. Now, why are they worried about it? Well, because in theory, and I think also in practice, it'll be borne out, units that are correspondingly adjusted will attain a basis to the premium side. So it'll trade at a premium to purely voluntary units. Why is that the case? Just because you have a bigger market. You've got government-to-government transactions, right? You've got compliance market entities that are subject to their government's compliance mandates, also looking for these units. And you've got this international system like Corsia also looking for these units. So you've got a much bigger pool of heavily motivated buyers, and that will bid up the price. And we see that on the tape as well. Whereas on the voluntary side, we just talked about it, essentially much softer market because of the softer demand. And so once we can unlock this potential with CAs, I think that then you really start to see much more liquidity emerge in the market and much better visibility around the basis spreads. You'll end up having a benchmark that's defined, and then you start to trade at a premium for the ITMOs, and without it, you'll trade at a discount to it. And it's no different to other commodities, how we trade Brent crude and et cetera. So that's just an observation teed up for Lizzie. What's your thoughts on CAs?
Oh, yeah. Well, that was just like, I felt like I was listening to a professor, because you did such a good job of laying it out. It's very complicated. And I'm so glad you did that, because I'm just going to jump into
shout out to Bjorn, because I learned it from him.
Developers. Yeah. So it's, as you said, the architecture for this in each country is very unique. And we're going to have to wait, and I'm afraid it's going to take a long time. And there will be some countries that are speedier, like, for example, Ghana in Africa is really the most advanced African country now, with 4 projects authorized for ITMOs, and others are going to be laggards. And we saw the same thing under CDM. For example, Venezuela didn't believe in market-based mechanisms, so they didn't even set up a DNA office at the time, a designated national authority. And at the time under CDM, the DNA had to give approval for all CDM projects, and it had to fulfill a sustainable development criteria, which was very vague. And it was very susceptible to palm greasing. And a lot of these countries, there's a lot of bribes and kind of shady deals that can occur. And unfortunately, when you have vague criteria like that, that can happen. And I'm a little nervous that we might be setting ourselves up for the same thing. We're relying on each country to set up their own registry. It's going to have wildly different timelines for that. And then also the process of cancellation. There could be a lot of areas where, like you said, a project developer talking directly to the government, not efficient, and also susceptible to bribes, susceptible to corruption, just as it happened under CDM, because I saw it firsthand. So that's certainly something. And then you see things like Zimbabwe. I mean, they put in place a 50% tariff on any CAs. So basically they were saying, if you're going to come in and develop a project here and you want a CA, a corresponding adjustment in our country, we're going to have a 50% fee on the sale of that asset that's going to go to the country. And they then ultimately ended up backing off that. And now I believe it's at 30%. But I mean, that's pretty
significant. Investment has chilled.
If you're a project developer and you're looking at going into a developing country where you've got all kinds of risk that you're facing in terms of the actual project success, and you layer on top of that the risk associated with fees that could change over time, and then you layer on top of that the risk of revocation of the letter of authorization. So that's the LOA is required by that particular country to say, yes, this has a corresponding adjustment associated with it, and this is a valid project. But there is now an insurance product that's required for all Corsia units that actually has insurance for the potential revoking of that letter. Because say you have a new administration come in power, they could very well revoke a letter that was previously given for a project like the Pakistan Delta Blue Carbon, which is in the process, if it hasn't already received its letter of authorization. So you've got all these extra risk layered on top of it, and that just really becomes super challenging. And so from a project developer standpoint, I have to admit, we really focus our development on the US and Canada, but we're tracking this and following it very carefully because, you know, given the right circumstances, we might be interested and open to developing projects abroad. I will say I work with a lot of US-based corporates, and the selling point for developers is really, if you're concerned about these corresponding adjustments, buy credits from the country where your emissions are originating from. And that's a good sell for us, given that I work with a lot of US-based corporates with emissions that are coming from within the United States, because at that point, there's no cancellation necessary. And so
but also the US is out of the Paris Agreement, so that's an interesting one.
Yeah, that's true. Larry, but in general, you know, if you are working within the country, you know, say it's Canada, where you have the project and you have the emissions, then you don't have to worry about that CA at the federal level. And so that is one way to kind of sidestep.
I think that's the solution. Like, it's staring us right in the face. Rich Gilmore published this last I think yesterday, because we were chatting about it, and then he published this on LinkedIn. And yeah, absolutely. This domestic kind of approach, it actually helps the countries to meet their NDCs, whether you call it a contribution claim or not. But if you're actually sourcing the emission reductions in country and you don't request the CA, then you're not creating scarcity for that country, but you're actually helping them along their decarbonization target. It's accretive. And so we'd encourage more corporates, again, to participate in the market first and foremost, have that tacit endorsement, you know, it's safe, come on in. And then, like you called it, the safe harbor, and then to have that focus around tying the purchase of carbon credits in the markets where you have your emissions. Because let's face it, everyone will have residual emissions despite their best efforts to decarbonize and reduce those emissions. So let's focus on the emissions reduction hierarchy. Let's reduce, but then offset the balance. And then the corresponding adjustment piece really becomes, as it was intended in terms of this complexity, for international trading between countries to help to promote trade between countries. And obviously, if that's a requirement in the compliance regime here in Singapore, you need Article 6 for ITMOs as part of submitting in lieu of the tax. And then you've got it under CORSIA. You mentioned also the requirement for this insurance, which is another layer of complexity. And that's great. These demand signals will start to emerge. And what I hope is that this complexity actually leads to greater fungibility and greater trade. And like, it's no different to other financial markets. That complexity actually encourages greater participation. And capital gets allocated based on that risk spectrum. If you're risk averse, you kind of go to kind of very basic products with very low yields, and then you go up that emerging markets kind of risk gradient, and then you seek a greater return on that investment, and that's great. And with greater risk comes greater reward. Essentially, is the kind of paradigm there. And so I think that this is a really exciting time. It's really interesting. And look, I'm not criticizing the project developers. Like, they're doing their very best. We know a number of folks, who are continuously trying to get these outcomes because they're really passionate about what they're doing. They're doing really great work. Shout out to Coco and Bern and to a number of other project developers in Kenya, for example, where we've got clients that are working there. Verity in particular, who's doing some great work on the afforestation side. But who these guys are trying to get these corresponding adjustments, or at least the letters of authorization with that revocation insurance piece, and it hasn't yet unlocked. And that will eventually have to sort of write itself out, and there will be an outcome. And when it does, then there will be supply for various compliance systems. As an anecdote, I talked to somebody the other day who's in Montreal for the ICAO event. They shall not be named. And we were talking about the lack of actual supply in CORSIA.
I'm like really concerned about how the CORSIA phase is getting more stringent, and seeing the lack of letter of authorization. It's like, how are they possibly going to meet these targets given the demand that's required? And like you said, the price is going to go up. There's a lot of complexity. It's job security for us. But I tell you what, it's going to be really fascinating to see if the letter of authorization can keep up with demand. Because I suppose if the price gets high enough, then those countries are going to start moving quicker. But
that's the trick. And I don't think that there's a fair and open system right now. We've got some ideas that we're discussing with some folks around potential ways that you could unlock that. But it is really inefficient and opaque. And because it's been negotiated on a bilateral basis between project developers and host countries, I just think that's got to change. I'm actually going to add another graphic to the screen, and I'll get Olaf to put that up. But it also comes from Bjorn's Unlocking Carbon Markets in Indonesia report, where he brings in a source from IATA, where it shows exactly what we've been discussing, right? Around CORSIA, there's a lower bound of demand and a higher bound of demand, right? And it's got it for different periods of the compliance. So we're talking phase 1 here, which is this 24 to 26 period, and then for compliance 27 to 35, broken into smaller periods. The demand, whether lower or higher bound, is still exceeding the current supply, and that creates a short squeeze. And essentially now everything's predicated under CORSIA around the penalties for non-compliance, right? And given sufficient penalties, I think that will start to unlock the supply side, because essentially whether project developers or others, financiers, can now actually start to come in and bid up the price of the corresponding adjustments, so that there are greater revenues to the host countries, so that can ameliorate their kind of export of these corresponding adjustments. And actually now you start to see more flow, right? And I think that's the bit. We need penalties on CORSIA non-compliance, and then you start to see the flow of those CAs. And right now the prices are way too.
It's going to be super interesting. And a shout out to AIDA. They have an Article 6 tracker that might be fun to put in the show notes as well. I know you mentioned another AIDA tool earlier as it related to Article 6. And I think a future show, Rene, you should do one on the IMO and their new proposed system for reductions in maritime emissions, and just trying to give us an early view on what you think of that market. But that's a whole other.
Eddie commissioned an internal analysis on that for the team. So let's get that done. And we'll have to get an expert coming from that space, because I'm certainly not going to purport to be an expert on IMO. I've had the fortune of working with a lot of aviation folks throughout my career. I find it's an area that I find, in terms of intellectual curiosity, incredibly interesting. My mum, for what it's worth, flew crew for Braniff, and so I just have these kind of core memories of being a little kid, with my mum, flying, and so I have a real great affinity for the aviation industry. But yeah, IMO. Let's put it on the to-do list.
Yeah, I forget who it was because we discussed that when the IMO came out with that carbon pricing mechanism a few weeks ago.
But let's do a deep dive.
I'd be so interested. I originated eLCFS contracts with the ports of Wainimi, LA, and San Diego for Blue Source. We work with those ports on helping them earn LCFS credits for their container ships and their cruise ships that are idling. Rather than idling on number 6 bunker fuel, they're plugging in now, and they also, all of the LCFS revenues they have to reinvest in electrification. And so I got really deep into the maritime world, going through that and working with all those ports. And so that's why, and this was back in 2018, 2019, when they first began to earn credits for that activity. And so now I'm really excited to dive back into it and learn about the new IMO regs and how they're going to play out. But I know too, Eddie, I know you had prepped this DMRV idea, and I think we should talk about it just for a second, because I do have a couple of thoughts. Because we specialize in forestry, and I definitely am excited for this, and I also have some thoughts. So maybe you want to tee it up.
Yeah, no, that's a great segue.
Thanks, Lizzie, for diving in on the editorial side.
Yeah, there we go. Yeah, I think it's a great thing for the market. So in the landmark development, the Alcott Blue Carbon Mangrove Restoration Project in Senegal, VCS 4653, has become the first carbon project to enter validation using a fully digitized methodology, right? So a version of VM 0033 developed for tidal wetland and seagrass restoration. So this partnership links Verra's project hub with Hedera Guardian, enabling structured data intake and automated checks. And the result is a move away from slow manual validation and toward machine-readable methodologies, real-time QA, and ultimately an automated, digital MRV-based system, which people have been talking about for a super long time, and which is, this kind of fragmented market. That's kind of what's been holding it back. These really long PDFs that are really slowly operated by the human system, right? So Alcott's digitized methodology includes 30,000 lines of code built using its Stratos platform, and this enables direct integration from field data to Verra's systems via blockchain secured infrastructure. So, the implications are significant. I saw a lot of folks in the market reacting to this news and saying, this is a really big deal, because validation timelines could shrink from months to weeks, and smaller projects, under 1,000 hectares may now become financially viable. There are a lot of social and ecological co-benefit data that could be better captured, and there's future benefit sharing models that could use smart contracts and digital wallets. So certainly it's super, super good for the market, for Verra, the largest standard, to be kind of, catching up to, I think, what other folks have done, right? Because Eco Registry had done this with Hedera a few years ago, if I'm not mistaken. So would love to hear your guys' thoughts on this and how big of a leap forward this is for the carbon markets. Do you think we're witnessing a true shift from analog to digital infrastructure? What are the key challenges in digitizing methodologies, and how do you balance that automation with complexity and nuance in the models?
Rene, I'm happy to jump in if you want.
I feel like I'm getting the last word. How about I dive in and then give you the last word?
Sure. Yes, please do.
Is that all right?
Yeah.
So, okay, cool. So I did another podcast last night with Adrian Wands from Senken and from Anna Lerner Nesbitt from the Climate Collective. And we didn't talk about this specifically, but we talked about this kind of intersection between Web3 and the kind of, like you called it, digital and analog markets. And I went on record then, and I'll go on record again, saying that a lot of folks I've received in terms of feedback personally over the last few months that kind of think that I've been really critical of Vera. And I have, but so the reason is because I'm really, I hold them in such high regard. Like Vera is a core foundational program and, architecture of our market, right? The folks that have gone through there, I hold incredibly high regard. I count many of them as friends. And I just want to see them succeed. And so the criticism around that sort of I've been very vocal on is this inefficiency with regards to the processing times of the projects through validation verification, because of essentially a reliance on a manual process, beginning with the PDD, which is a really lengthy document that is written, and it's like an essay. It's a creative writing essay, right, with a whole bunch of data points, but it's not standardized, and so there's no homogeneity with it. You cannot compare a PDD to another PDD. You have to basically read them line by line, and it's not scalable, right? So that's the first bit, and then each stage within the verification and the monitoring, reporting, verification, I should say, of these projects is essentially paper-based. And so I love the fact that we're seeing this innovation emerge. And shout out to Hanya and the team at Hedera. Shout out to Mandy and her team at Vera for making this now a reality. I know that this has been going on in the background for a long time, and it's fantastic to see the first instance of it. Like, again, also shout out to Olcott, Alexi and Raphael there for Olcott.io, who have really shown that level of innovation to be the catalyst to drive this, because they're the ones that digitized this PDD, right, and the methodology, and then have now created that first template. I just hope that now we see this as a really viable pathway via which other project developers can really start to ramp, and we address this speed and scale issues that have been plaguing the market. Vera today represents such a large portion of the supply pool, and we've effectively had this interdependence, and I think this huge concentration risk, quite frankly, I'll call it out, on Vera and becoming, this one choke point. So then all the criticisms then get lobbied their way. Now, I'll remain critical around the transaction fee thing. That's a hill I'm going to die on. I just don't think that's very strategic at a time of illiquidity in the market. But putting that aside, this is fantastic news. And so that's great. And I think, we should, as you mentioned earlier, Eddie, in your intro, the eco registry folks they also joined forces with Olcott and with Hedera, I think last year, if I'm not mistaken, September timeframe. So they kind of set the precedent, but they're a really innovative but smaller registry and representing obviously a standard like Carbono. It's good to see them, who is a native blockchain registry, embrace this technology. Surprise, surprise. But Vera, who's not a native blockchain standard program or their registry through APX, my old friends at Expansive, shout out to the Expansive dudes, embrace this new approach. I think that this is great. It leads to greater transparency, the immutable record, the speed with which this could all occur would be fabulous. And it leads to smart contracts. It leads to the potential for the DMRV to be automated. So you could have an Internet of Things type of model where data is ingested and actually reviewed, ingested, and kind of codified, leveraging artificial intelligence, machine learning. And we could have a much higher throughput. If you think of Carbon, or Vera as a factory, actually, if you think of Vera as a factory, you have input, and then you have eventual output in the form of the VCUs. There's this black box that we don't know what happens in the middle, and it just takes forever, seemingly, and project developers are really frustrated with that lag because it makes their financing almost impossible, right? Like, when am I going to get issuance so I can monetize these credits? Because we talked about the offtake piece. If we can actually increase the output and make it kind of like a PPA, we can have quarterly issuance, and you have like real-time monitoring, and you have a lot more reliability with regards to data, as opposed to one big data dump every 3 years. Like, hallelujah. Hallelujah. So big rant, but like, shout out, congratulations to all parties involved.
Oh, so much to say there. And Rene, what you just described sounds a lot like the REC system, more quarterly and but the difference between RECs and offsets we have to remember is the additionality component. And you hit the nail on the head when you said PDDs are like these creative essays. I hate to harken back to CDM, but hey, most of Vera's methodologies came over from CDM. They were adopted, right? And so the whole process was the person with the best English speaking consultant has the most likelihood of getting you an FCCC approval. And it was this essay contest, if you will. And we have to move away from that. And I really saw with CAR, the Climate Action Reserve, they adopted more of this positive list approach. And I think in order to make this DMRV really increase and accelerate the time of issuance and the time of approval, and like you said, the factory to move faster, what we really need is we need to make sure we set clear parameters and guidelines on what is additional and what is non-additional. And maybe
at the methodology level.
At the methodology level. And so if there is a technology that has less than 5% market penetration, maybe we just go ahead and say, hey, it's additional. If it's less than 5% market penetration, it needs the benefit of a carbon subsidy. So let's not go through this process of writing this essay, which is super subjective and depends on what kind of consultant you have. And we'll just
and the dialogue with the standard,
and that's the positive list, and that's where we need to go. But it's not the DMRV that's going to save us. It's definitely the methodology and making it clear, and then of course the data and being able to do more quarterly issuances and having that process flow quicker is certainly very promising. But I think we do need to remember that it's the architecture of that, basically the standard and what they have deemed they're going to use for their additionality argument, and making it super clear for each project type how you prove additionality. And we need to make it cut and dry, and we need to have less subjectivity in it. And it could be that after time, if a particular technology increases, like we talked about renewables, then it's going to surpass that 5% threshold, no longer be additional, and that's fine, and that's great, and it gets phased out. But we need it to be more cut and dry if we're going to scale. And I think that like you said, we can't have this PDD. But the sad thing to me is I'm seeing a trend in the market going the opposite way, with the ratings agencies and with the hiring of consultants to make sense of what's a high quality offset in the wake of the critique from various news outlets of these instruments. What we're seeing is now we're seeing clients hire these folks to write 60-page reports, adding a tremendous amount onto the transaction cost of the unit. And then it's even more complicated because you're going into like an even more complicated argument about that project. We need really cut and dry guidelines for what qualifies and what doesn't and why. And it's okay if those change over time as economics change, policy changes, et cetera. We got to update these methodologies more rapidly. And it's really incumbent on the standards bodies to set the bar really high. And then all buyers of a certain methodology version know that they're getting a certain quality. They can have confidence in the quality of the product if those methodology versions are keeping up, rather than having to go on a project by project expedition of trying to find this nugget of gold and getting 6 different rating agencies with different views on it and different ratings of that same project, which I think is confusing the marketplace. And so, in my opinion, it's really incumbent on those registries to do a better job of quickly responding to new developments, setting the next version of the methodology, and then everything under it's the same. And then we can integrate DMRV. And I want to say one quick thing on DMRV, because I can't speak to all projects, but we develop a lot of forestry projects, and I've been out on dozens of forestry project site visits. And DMRV works really well for certain things, but when it comes to forest carbon, it cannot take into account the understory. So you don't get an accurate reflection of the carbon content of the forest unless you're able to quantify the understory carbon. And you can't do that yet with satellites. It's not to say it isn't coming, but satellites miss that. And a lot of times they can see the canopy, but they're not getting a clear picture. And under ACR's IFM methodology, they do quantify the understory carbon as it should be. And so, you know, we've done some work with backpack mounted LiDAR to get a better picture of the underground or understory carbon quicker. But I do think there's no substitute for boots on the ground when it comes to forestry carbon quantification. But it comes at a cost. I mean, we're flying helicopters into some of our remote Alaskan projects to do verifications. Think about the fossil fuels and the time and the money to do that. And some of these projects have 300 permanent plots. And then you go and every verification you audit 10 to 12% of those. And that's a lot of money. And so I think that we will, as technology improves, hopefully get a better picture of the understory. But currently, we're not there. I will say, though, the new IFM 2.1 under ACR does use satellite imagery to establish the baseline, which is super cool. It's a new dynamic baseline approach, and they're using satellite imagery to see how neighboring properties of the same landowner type, same forest cover type, slope, elevation, aspect. So you have a similarity index, and you find 8 similar properties that are surrounding in the same wood basket within 150-mile driving range. And then you look at how those landowners are literally managing their land on the ground, real world, real time conditions, and you do that using satellite imagery. And we actually work with a satellite imagery partner to get up to 0.5 meter resolution. So we're buying satellite imagery to get even the latest, greatest, not going with like the industry standard, which is 30-meter resolution, but we're getting down to the individual tree level so that we can see what's going on. And that helps establish the baseline. And so we are using satellite imagery, but we still have a little ways to go to make sure that we can get the understory carbon. And for that reason, in forestry, I don't know if DMRV is going to get to that point, if we're going to be able
of
to
granularity,
completely automate it. But
yeah, no, I don't think we will. But you just highlighted like the process that you have ground truthing, and then you have LiDAR, and you have other sort of geospatial that you then stack on top of each other. But all of that data is relevant, and it's going to have some sort of tolerance risk or some other sort of resolution issues. But stacked on top of it, you can effectively create a very accurate picture, and then you can have the buffers and obviously the baseline setting to get it within and dial it in within range. It's just, again, coming back to the concept of the digitization of the methodologies, it's rethinking it from a system architecture perspective. And I want to shout that out. We had Thibault Soria and Judith Simon on the pod a couple of weeks back, where they discuss around the benefit that ERS, the Ecosystem Restoration Standard, has is that they're starting from first principles, and they're seeing the kind of flaws in the historical legacy standards, and they're rethinking it. I think Vera is now realizing this, whether pressure or through innovation of their own, right? That the process can become much more efficient and effective, and we'll see how it goes. So I think we're in wild agreement, and thank you for giving us that masterclass on the realities on the ground and the kind of limitations they're in technology. Technology isn't like this panacea. It's not going to be like the one miracle cure thing here, but it will aid in terms of that greater transparency and ultimately rebuild the confidence in the market. The one thing that I think, and we've agreed widely on everything, Lizzie, but I'm going to disagree with one thing around the rating agencies. I'm a big proponent of rating agencies because they're another third party that comes in and provides a subjective viewpoint. And then they are not rating around a quality spectrum, but it's a risk spectrum. And so when you talk to B0 and Silvera and Calix, and I hold those three really in high regard, they're really evaluating projects based on that limitation of data. What, interestingly, they've all done is actually do the digitization of the paper-based PDDs so that they can actually have the ability to have searchable information, compare that with the geospatial, and then derive their assessment, right? Their view on what that project rating ought to be. I think it actually helps the market because it provides buyers with a view around where they want to be allocating their capital, and I think that's a good thing. If we can start from first principles and have digital PDDs and digital DMRV and all this other stuff to go digital, we can actually have systems that can process that data much more efficiently. And then those rating agencies can do their thing, investors can do their thing, capital allocators can do their thing much more efficiently. And we can actually start to see the liquidity grow. So anyway, I think it's good. Innovations, we should encourage it, and we should really celebrate it when it shows up. So
yeah,
that's it.
I think just one final thing on the rating agencies. I do think that they have grown and learned the methodologies better, and they're maturing for sure. They are still standardizing their approach, in my opinion, and coming up with weighting factors for these different risk categories, which do vary by project. And it is somewhat of a black box when you look at how they're rating. They have produced various reports, but then when you really dive into it and look at how they weight the different categories, it is not always consistent. And so it's challenging to interpret and make sense. And I do think, there are some great ratings agencies out there like Calix that only use public documents. But there's a lot that can't be made public for reasons of protection of landowner or project owner. And it's not to say it can't be shared under NDA, but it does enlighten and inform a lot of information about the project. And without that, it's very difficult to make sense of it all. I understand in principle why they only go with public documents, but the reality is there's a lot of sensitive information. And, timber industry is a super competitive industry. And so putting all the data out there is not a realistic reality for these landowners. And we would be in violation of confidentiality if we did that. So I do think that they're maturing. And like bond ratings, they will begin to standardize their approaches, and it will become more and more useful over time.
I agree, and I think we're in the early innings. Like they're discovering the data, the limitations therein. You highlighted one, and they're figuring out how to actually provide that product market fit. Like, where do they sit within the ecosystem? What value do they add? What is what is the price of that analysis, and who's willing to pay for it, et cetera, et cetera, et cetera. But over time, as the market continues to grow, their solution will evolve. And I do think that then we'll start to see rationalization and kind of the standardization. That's just the normal evolution of innovation. But yeah, I don't want to dissuade anyone from leveraging those insights. Information is power, and if you have more information, you can make better decisions, whether it's on the trading side, whether it's on the carbon neutral claim side, or whether it's on others. I know governments look towards the rating agencies for their excellence with regards to sort of data integrity, et cetera, as well, and helping to shape policies as well. And I think that it's all accretive. I think we just highlighted for an hour and a half, and I know we've probably got to wrap soon, the complexities of this market. And it's really exciting to see this level of maturity. And that's what happens. Complexity increases as you have this maturity. It's kind of like
it's happening. And we're 20 years in, we're 25 years in really. And
don't look a day over 21 there.
We're iterating upon it. It's the iterations are a feature, not a bug. And I do think just a future show that you should do is you've mentioned blockchain briefly. And for a while, Gold Standard was really interested in perhaps integrating blockchain in their methodologies. And then we saw the whole claim a DAO fiasco occur. And in the process of trying to provide transparency through blockchain, we actually increased opacity because we combined these kind of low cost, older vintage VCUs with high cost and sold them to people that didn't really know what they were getting. And then, we had this issue of kind of burning and retiring and the concern over double counting from the registries. And now we have a total pause on the use of blockchain or taking credits on chain. And I would love to hear your thoughts on that. And then also the evolution is it going to come back, or where are we going to go? Or maybe we just use blockchain without tokenization.
That's a great idea for a show. So I've got a story for it. Let me give you the Bridge Notes version, and then let's invite some folks back. Two future shows that we've got. Sorry, Eddie, we've hijacked your show, mate. So the first one, we've already invited Hania Othman from the Hedera Foundation and Mandy Rambaras from Vera to join us, and we'd welcome both of those ladies to join the show and to talk about this innovation that we just discussed around digitization approach that Vera's taking. And then the blockchain piece, obviously Hedera's got this blockchain, fundamental basis, would be really interesting to unpack. I actually spoke to Philippa from Northern Trust earlier in the week, found that conversation to be incredibly interesting. To see a large custodian bank like Northern Trust, you have, BNY Mellon, State Street, JP Morgan, BNP Paribas, and Northern Trust as the big custodian banks within financial markets, actually step in they've been working on this blockchain registry where you cannot issue, there's a legal nomenclature around why, but you register units natively onto that registry, and then they can provide the settlement within the financial markets ecosystem. They're highly regulated by the US regulators because they're a US bank regulated by the CFTC and the SEC. And because they've been basically denoted these instruments as commodities, they're regulated under the CFTC for this very purpose. It's highly regulated. So banks and institutional investors can now rely on that infrastructure. What they're going to do over the next few years will be really interesting to watch. And so I'd love to get Philippa and Anthony from Northern Trust on a future episode to kind of expand on that universe as well, because there's a huge amount of innovation that's been kind of brewing out of left field. You highlighted the clean McDowell. That was a really interesting story, and I've kind of covered that before. But this is this intersection of fintech and classic finance that's going to, I think, potentially unlock quotients of capital that we're not used to. Right now, the market is fine in terms of the ecosystems at the registry and exchanges and OTC for doing transactions in the hundreds of thousands, tens of thousands, tens of millions potentially. But when you start to breach hundreds of millions and even billions of dollars of transactions like occur in the financial markets, you need really strong settlement infrastructure. And obviously, my former team at Expansive did an amazing job with regards to clearing and settlement on the exchange side at CBL. And so does, obviously CME and ICE on the futures. That's their bread and butter. But having now a custodian bank wade into the ring will be really interesting to see how that evolves and whether that begets greater participation from those institutional investors that can, custodialize capital and units on the product side, the product encumbrance with a custodian bank. They have certainty. Hedge funds do it every day, right? And in terms of leveraging these custodian banks, and they're used to handling billions and billions and billions of dollars on a daily basis, even trillions of dollars. And so I think it'll be an interesting paradigm shift that we start to see. So thanks for the ideas.
I'll be listening.
Eddie,
I'm going to tune in for those. But thanks so much.
Cool.
This has been a lot of fun.
Yeah, thank you so much for joining.
Appreciate it.
Yeah, I really appreciate your insights. And it was a really great discussion that dove into a lot of different topics there. But I'm sure we could keep going for like 4 hours, but unfortunately, that's not going to happen. Yeah, exactly.
I mean, it's getting a little late where you are. I feel bad.
No, it's all good. But so thanks for tuning in to This Week in Carbon. Be sure to follow the show and share it with someone interested in carbon markets or who's just carbon curious. And we'll catch you next week.